Welcome to the channel, everybody. Today, we're diving headfirst into the exciting world of investing. Now, whether you're already making seven figures or just starting out on your financial journey, understanding the different ways you can invest your money is absolutely crucial for building long-term wealth. We're going to break down the different asset classes you can invest in, from the stock market to real estate and everything in between. We'll explore the risks and potential rewards associated with each investment so you can make the most informed decisions for your own personal financial goals. Remember, investing doesn't have to be scary or complicated. By the end of this video, you'll have a solid foundation of knowledge to start growing your money like a pro. So buckle up, grab your notebooks, and let's get started. First up, let's talk about stocks. Stocks are basically like little pieces of ownership in publicly traded companies. Think of it like buying a tiny slice of your favorite pizza place. Except instead of getting free pizza, you get the potential to earn money through dividends and stock price appreciation. When you buy a stock, you become a shareholder in that company. That means you're part owner, even if you only own a few shares out of millions. As a shareholder, you get to participate in the company's success. If the company does well, its stock price typically goes up and your investment grows. But remember, just like with any investment, there's risk involved. Stock prices can go down too, especially if the company faces challenges or the overall market takes a dip. That's why it's super important to do your research, diversify your portfolio, and invest for the long haul. Don't put all your eggs in one basket, and don't panic sell if the market gets bumpy. Now, there are different ways to make money with stocks. One way is through dividends. Some companies pay out a portion of their profits to shareholders on a regular basis, like quarterly or annually. It's essentially a way for companies to share their success with their investors. Another way to make money with stocks is through capital appreciation, which is just a fancy way of saying the stock price goes up. When you sell your shares for a higher price than you bought them, that's a capital gain. And remember, you only pay taxes on those gains when you actually sell your shares. Investing in individual stocks can be exciting, but it's important to remember that it requires time, research, and a bit of risk tolerance. It's not a get-rich-quick scheme, but rather a long-term strategy for building wealth. Next up, let's talk about bonds. Bonds are like loans you give to governments or companies. When you buy a bond, you're essentially lending money to the issuer for a fixed period of time, and in return they promise to pay you back the principal amount plus interest. Think of it like being the bank. You're lending out your money, and the borrower is promising to pay you back with interest. Bonds are generally considered less risky than stocks, especially if you're buying bonds from stable governments or well-established companies. Now, there are different types of bonds, each with its own risk and return profile. Government bonds, for example, are considered very safe because they're backed by the full faith and credit of the government. Corporate bonds, on the other hand, carry a bit more risk because the creditworthiness of a company can fluctuate. Bonds can be a great addition to any diversified portfolio, especially if you're looking for a more stable investment option than stocks. They can provide a steady stream of income and can help reduce the overall volatility of your portfolio. Just like with any investment, it's important to do your research and understand the risks involved before investing in bonds. Make sure you're comfortable with the creditworthiness of the issuer and the maturity date of the bond. Now, let's talk about everyone's favorite topic. Real estate. Real estate is all about investing in physical property like houses, apartments, commercial buildings, even land. It's a tangible asset that you can see and touch, which can be appealing to a lot of investors. One of the main ways people make money in real estate is through rental income. You buy a property, rent it out to tenants, and collect monthly rent checks. It's like having your own little business, but instead of selling products, you're selling housing. Another way to make money in real estate is through property appreciation. Over time, real estate tends to increase in value, especially in desirable locations. So you buy a property today, hold on to it for a few years, and when it's time to sell, you could potentially sell it for a profit. Now, real estate investing isn't for the faint of heart. It requires a significant amount of capital. It's not as liquid as stocks or bonds, and it comes with its own set of risks like property damage, vacancies, and difficult tenants. But don't let that scare you away. Real estate can be a fantastic way to build long-term wealth, generate passive income, and diversify your investment portfolio. Just make sure you do your due diligence, crunch the numbers, and have a solid plan in place before you dive in head first. Let's talk about mutual funds, one of the easiest ways to start investing. Mutual funds are like baskets of stocks or bonds that are managed by professional money managers. It's like having a personal chef for your investments, except instead of cooking delicious meals, they're selecting and managing a portfolio of assets. When you invest in a mutual fund, you're pooling your money with other investors, and that money is used to buy a diversified portfolio of stocks, bonds, or other assets. This diversification is key because it helps spread out your risk. Mutual funds come in all shapes and sizes. There are mutual funds for every investment goal, risk tolerance, and budget. Whether you're looking for growth, income, or a combination of both, there's a mutual fund out there for you. One of the main benefits of mutual funds is that they offer instant diversification. Instead of buying individual stocks or bonds, you can invest in a mutual fund that holds hundreds or even thousands of different securities. Another benefit of mutual funds is that they're professionally managed. You don't need to be a stock market expert or spend hours researching individual companies. The fund managers do all the heavy lifting for you. Now let's talk about ETFs, or exchange-traded funds, which are like the cooler, more modern cousins of mutual funds. They're similar to mutual funds in the sense that they offer instant diversification and track a specific market index, sector, or theme, but they trade on stock exchanges just like individual stocks. Think of ETFs like a basket of goodies that you can buy and sell throughout the trading day. Each ETF share represents a small ownership in that basket of underlying assets. ETFs have become incredibly popular in recent years, and for good reason. They offer a number of advantages over traditional mutual funds, including lower fees, greater transparency, and the flexibility to trade throughout the day. One of the biggest advantages of ETFs is their low fees. Because ETFs are passively managed, meaning they track an index rather than trying to beat the market, they have much lower expense ratios than actively managed mutual funds. Another advantage of ETFs is their transparency. ETFs disclose their holdings daily, so you always know exactly what you're invested in. This is in contrast to mutual funds, which only disclose their holdings quarterly. Finally, let's talk about commodities. Commodities are raw materials or primary agricultural products that are traded on commodity exchanges. We're talking about things like gold, oil, natural gas, corn, wheat, soybeans, coffee, sugar. The list goes on. Investing in commodities is a bit different from investing in stocks or bonds. When you buy a commodity, you're essentially betting on the future price movements of that raw material. You're not buying a piece of a company or lending money to a government. You're buying a physical good. Commodities can be incredibly volatile, with prices fluctuating wildly based on supply and demand, weather patterns, geopolitical events, and a whole host of other factors. It's not uncommon to see commodity prices swing by double-digit percentages in a single day. So, why would anyone invest in commodities? Well, for one, they can offer a hedge against inflation. When the prices of goods and services are rising, commodity prices tend to rise as well. Another reason to invest in commodities is to diversify your portfolio. Commodities don't always move in the same direction as stocks and bonds, so they can help reduce the overall volatility of your portfolio. Thanks for sticking with me, everyone. I hope this video gave you a better understanding of the different ways you can invest your hard-earned money and start building long-term wealth. Remember, investing doesn't have to be scary or complicated. Start small, diversify your investments, and don't be afraid to seek professional advice if you need it. The most important thing is to start investing early and consistently, even if it's just a small amount each month. If you enjoyed this video and found it helpful, be sure to give it a thumbs up, subscribe to the channel for more awesome finance content, and hit that notification bell so you don't miss any future uploads. Happy investing! Thanks for watching. We hope this video helped you understand the different types of investments. Don't forget to like, subscribe, and hit the notification bell for more informative content. Happy investing!